Hey, what's going on, traders? So in this video, I want to talk about a concept that I believe into, a belief that I have about valuing specific stocks that generally speaking, this is my belief, high growth stocks have an expiration to it. And for them being high growth, even if they kind of continue to be high growth. And here's why. And this kind of comes down to if you're chasing Tesla. I see a lot of people who are huge Tesla fanatic companies or huge stock lovers of Tesla today. I bought Tesla, first bought Tesla in 2018, and it's gone up a crazy amount since then. And now I'm not as bullish on Tesla. I still think it's a good company, but to expect that the next 5-10 years of Tesla will have the same growth as the previous 5-10 years is actually just really dumb. And I think a lot of people have this, and it's like chasing it. And here's why. So let me show you my computer right now, and I want to show you something. And what I'm going to be showing you is a chart of 5 companies and their historic PE ratio. And I want to start off with Google. All right. So this is my theory. There's no magic behind this. Again, not financial advice. It's just my opinion. I personally believe that the more established the company gets, the lower investors will price their PE ratio. So you take, for example, Google. They've been around for a long time, much longer, and they've been a stock for a long time, much longer than Netflix, Tesla, Shopify. Amazon's been along for a long time as well, but it's a pretty established company. People have been, Google, and the thing is, it's also, they've had an established business for a while. If you take Amazon and Netflix, who've been around for a long time, they've been around for a long time, but they haven't shown profits for that long. Google's always been, pretty much a profitable company per se. So if you look at this, this is the PE ratio. So, 5 years ago it was 35. Right now, 17 and, 19 because the market's down. That kind of makes sense. And that's a dip for sure. That's definitely a trend down, but nothing too crazy. It's a pretty big dip, right? But then let's look at Amazon. All right, let's look at the last 5 years. It's a pretty fat dip. You're going from 300 to 95, 3 times less. Look at that. As low, it got to 45, stuff like that. Now, this is actually a little bit inflated because of the fact that Amazon's not showing profits. They actually, the last previous quarters, they lost some money. So that's why it's a little not accurate with here. So if they were making money, you would actually see that the PE ratio would be going down. But it's because they've shown a few L's recently. Take Shopify, for example, all right? And again, Shopify is kind of in that scenario as well. You can see they went from literally, peak 700 PE ratio. I remember I saw Shopify at 700 PE ratio. I was like, there's no way, and they're going to keep that up. And then, boom, dipping. And this PE ratios, this is not exactly an investor's, this is not the value of the company, but generally you will see that downwards trend a little bit with that. And that's a lot to do because we're in a bear market. However, my thesis here is you're not going to see such high returns as you did in the future. Now, a lot of this has to do because they reported stronger earnings, essentially, is what happened. Okay. Now, let's look at Tesla. So this is the concern I have for Tesla. And a lot of people that I think are huge Tesla fanatics, people are like, oh, Tesla's going to triple in the next year. No, it's not. It's just not. They're not thinking about this. They're not thinking that Tesla has now shifted to an established company. Like they used to be, in 2018, 2017, people always oh, it was such a shorted stock. And everyone who would talk to, Kevin O'Leary, and people go on news channels, stuff like that, it's a garbage. I remember that I watched a video from Kevin O'Leary, I love driving my Tesla, but I hate the stock. I'm like, that makes no sense. That's no common logic there. If you love the product and you believe in the product, it's kind of weird to then hate the stock. There can be reasons for the financials and stuff, but it's kind of weird. And look at Tesla, peak 1,300 P ratio, and now Tesla has been beefing up their profits, so that's why the P ratio is down quite a bit. But it's clearly that people are not valuing it as much again in the future. So I wouldn't be surprised, and because here's the thing, if you're what a lot of people do, they'll do a forward estimate, right? They're okay, what if Tesla is making $20 billion in a few years from now. Let's just say they double their profit. And if they keep their PE ratio of 75, then they're going to be valued this much. Well, the thing is, and this has happened to Facebook. Facebook, prime example. Facebook has massively grown their profits, but the market capitalization of them has not grown that much. And it's because, again, they're like, okay, this is an established company. They're not growing as fast anymore. We're not going to give, like, even though they're making more profits, doesn't necessarily matter. You know, it's because that was already priced in. That's the thing. It's people are already pricing this in. And that's what happens with these huge growth companies. They have such a high PE ratio because there'll be some people like who invested in Amazon a long time ago or into Netflix, and they're like, we see something that other people don't, but now people see it. So that's kind of the issue behind it. We can look at Netflix. Netflix is another really good example. You can see, okay, really, really high PE ratio. And this is before COVID, right? This is, 2018, 270 PE ratio. And again, this is people are like Netflix did return very well, but this was a situation where people clearly saw Netflix was going to go in one direction, others didn't. That's why thus you had such a high, and obviously they're not making profits, things like that, and now you're going to see a dip. So, I wouldn't be surprised that one day, 10 years from now, you're going to see Tesla's trading at 20 PE ratio, 25, 30. And that can happen. It happens all the time to companies. Look at Facebook. Now, I'm not saying Facebook and Tesla are the same thing. Actually, I keep saying Facebook. Let's pull it up. I think they're the Meta now, right? They're not FB. Let's look at this. 5 years. It's actually not. Yeah, I mean, that's really cheap. 10. That's crazy. 10 PE ratio. But anyhow, I guess it's still down 3x. The chart's a little different. But anyhow, that's kind of what I'm referring to. Is that's something to understand with growth stocks, and that's why it's so hard to pick stocks, because if you're going for those high growth stocks, you might be right in a bull market, but anything goes up in a bull market. But it's kind of over the long term, and those factors can play out. So hope you like this. If you like it, subscribe down below. Leave a comment down below as well. Like this video, share with anyone that needs to hear about this with growth stocks, and I'll see you in the next video.